100% of my time with you today is going to be focused on that one topic, which is what the heck does it take to get through the nasty bit with your career intact, knowing that this shift from level 1 and level 2 operating models to level 3 and level 4 operating models is going to have some significant investments, and as JB showed you in the fish chart, going to have probably some deferral of revenue that you're going to have to take to get from here to there. So I'm really going to talk about 3 different aspects of this journey to get past the nasty bit. The first one is I thought it'd be good to just think about what the new competition is. And you'll see the consequence there is we better fear the one we don't see coming. So if you're IBM and you fear HP, or if you're Cisco and you fear Juniper, you're probably asking the wrong question, right? Because you can kind of tend to come to conferences like this and talk to your peers of your traditional competitors, and you kind of ask them, well, how's your level 2 business going? Oh, that's kind of all right. I'm okay. You're okay, right? Yeah, yeah, you're okay too? Oh, good. We won't do anything about this, right? It's the one you don't see coming that tends to kill you, so I'll give you a couple examples of that. The second is there's a new set of expectations that are coming, not just of you, but of your product peers and your product sales peers. But those new expectations are substantial. I'll kind of give you the inside and outside view of what we're hearing from the companies that we're working with. And the last part is I want to double click on what JB walked you through, which is these 3 pivots. Don't think of these 3 pivots as all you've got to do, because it's not all you've got to do to get to a B for B model, but they're the first 3 things that you've got to do, or we've become convinced that they're the first 3 things you need to do in the place that you need to get started. So we're going to be a little prescriptive about that. So the new competition, I'll tell you, the one you don't see coming tends to, in your industry, be the competitor who goes directly to level 4. They don't have a level 1 business, they don't have a level 2 business, and they really have maybe dabble in level 3, but they frankly say, you know what, I'm all in with my customer, I am putting 100% of my company in service to the outcome that the customer seeks, and I'm not going to, kind of bother my way with protecting anything that's established. And the lessons learned from these companies, I think, are quite interesting for you as you think about your strategy to actually get to B for B. So Kodak film, Now you'd say, Todd, maybe this is a picture you got off the internet from a long, long time ago, right? I'm sure you see these pictures all the time. This is a picture I took in February. I'm giving a speech in Florence, Italy for a division of General Electric that's thinking about this transition in their business model. And I happen to be walking along the street towards where my speech is going to be. This is just outside the Duomo. And it's quite fascinating because if you thought about the power brands that you have in high tech, they're probably as strong as probably Kodak was in photography circa about 10, 12, 15 years ago, right? They were by far the #1 brand in the photography industry, and they certainly had a business model which was unrivaled, right? It was the original razors and razor blades business model, which is I'll let someone else be in the consumer electronics business and sell the cameras. They didn't really make their money on cameras. They made all their money on the film. People remember that? Yeah? Well, the real Kodak moment was them missing digital, as you might imagine. Anybody guess who the company was that they didn't see coming? So this is the audience participation part of the meeting. Yeah? The one they didn't see coming was Samsung, which is interesting. So Samsung and Sony basically have equal share of the digital photography market. Yeah? And who would have thought Samsung, #1 photography company in the world? What's interesting is in 2 eras of digital photography, Samsung is the leader. Obviously, they're the #1 OEM of Android-based smartphones, which is where photography is headed. But even in that interim state between film cameras, film photography, and mobile photography, Samsung basically has 30% market share of digital cameras, and Sony has about 30% market share of digital cameras. What's fascinating is if you reverse engineer this example, Kodak had all of the early innovation around digital photography. They had skunkworks going on. They had the early innovations. They had digital cameras working in the lab. They knew how to cost reduce it and value engineer it to get the cost of digital cameras down. And you'll never guess what they did. They stared the nasty bit right in the eye and they blinked. They said, we do not want digital photography to happen. So we're going to keep that thing in the lab, and we're basically going to hold that back because that would cannibalize our incredible film photography business. And obviously, you know, smart people at Kodak, and I don't mean to disparage people that worked for Kodak. Some of you might have worked for Kodak, but that was a fateful move, right? I won't spend a lot of time on this one. Anand just talked to you about Blockbuster. Obviously, Netflix was the one that they didn't see coming. What's fascinating about the Netflix example, and there's kind of a takeaway from each one of these, is Netflix is one of the very few companies in business model evolution right now that dramatically destabilize themselves. It's one thing to be Samsung and saying, I'm going to go and eat the lunch of Kodak. It's a whole other thing where you basically say, we built up an entire brand around DVDs to the home. We built distribution centers with robotic distribution of DVDs so that for $8 or $10 a month, we can afford the round-trip cycle of DVDs going out to your house, right? They were the darling of that business model, so they were the attacker in that business model of entertainment in the home and basically unseated and eventually bankrupted Blockbuster. What's much more interesting about Netflix is the fact that they could basically do to themselves what they did to Blockbuster. Can you imagine the internal dialogue in their executive team when they basically had to look each other in the eye and say, either we're going to get to digital download of entertainment or somebody else is going to out Netflix. I'm very proud of this company. They're from my hometown of Los Gatos, California. So this is the one tech company that's actually in Los Gatos. But they basically were able to say, you know what? Those warehouses are redundant. All that innovation that we put into the robotic distribution is redundant. Our brand's got to change and stand for digital download. And we basically have to part with the past and move on. Very difficult thing to do. For those of you that own stock in your companies, what's interesting about Netflix is their stock's gone from $50 a share to $337 a share in the last year. So the world has basically seen through the turmoil of business model evolution and said, you know what? In the outcome-based model, which is giving customers exactly what they want, putting yourself fully in service to the outcome that customers want, in this case, immediate gratification of entertainment, Netflix is going to be the winner. The last one's going to be hit a little closer to home for some of you. And I could have picked on any of you up here, but I'm going to pick on IBM just for a sec. So IBM, this is October 7th, I think, Barclay came out with an analyst note on IBM and basically said, you know what? This SaaS thing affects every part of IBM's business. Because the IBM Global Services business is all about being the shock absorber between the complexity of a level 1 and level 2 offer and the customers not being able to absorb that complexity. So if you think of the big systems integration business of IBM, obviously an as-a-service world, an outcome-based world, or a consumption-based world is dramatically threatening to that. But equally, in terms of the mainframes, if you look at the leaders in the infrastructure as a service business, they're not tending to use IBM mainframes the same way that big banks and big insurance companies and big CPG companies have used IBM mainframes. What's interesting is then a week later, IBM misses its revenue forecast by $1 billion. So, you know, if I was as smart as the Barclay guys, I probably could have made a lot of money. Who is the company that IBM hasn't seen coming? I'm sure there's a number of them, but what's the company that maybe jumps to mind that you think maybe IBM just didn't see coming? Wouldn't have been on the radar? Amazon. Absolutely right. Because who would have thought that a retailer, a $60 billion retailer, admittedly an amazing retailer, right? Many of you, I'm sure, are Amazon customers. Amazon smiley face boxes are arriving at my house almost daily. But who would have thought that Amazon could basically say, we can do in infrastructure for small and medium-sized companies as well as enterprises what IBM has historically done, which is provide a safe and reliable infrastructure upon which to run your mission-critical applications. And at least in Silicon Valley, there were a lot of people that thought Amazon was a very cute little company, frankly, when they were serving small office, home office, small little apps, venture-funded startups. Kind of when you grow up, you're going to need the big guys. You're going to need HP or you're going to need IBM. As soon as Amazon won the $600 million deal from the Department of Defense here in the US to manage the CIA's data, I think they pretty much, you know, got validated as an enterprise class infrastructure as a service company. So Amazon is quite remarkable. Jeff Bezos, I'm sure you've seen, he boasts that 27 times over the last 7 years, Amazon has taken down prices for infrastructure as a service. Earlier this year, they did something that's pretty interesting. We're going to come to adoption service, and I'll give you an example right now, is in January, they launched something called Trusted Advisor. What Trusted Advisor does is it looks at your usage of Amazon Web Services, and it basically suggests a price plan that were you to move to that price plan, you would pay Amazon less. Think about that for a second. If the cell phone industry did that for us, there'd be $0 of profit in the entire cell phone industry, right? So Amazon is a $2 billion business in infrastructure as a service last year, 2012. The latest numbers I've heard is they will be a $4 billion business in infrastructure as a service this year. So growing 100% year on year off of a $2 billion base. And that's clearly the one that IBM didn't see coming, Cisco didn't see coming, HP didn't see coming. I'm not picking on IBM. But Amazon is the one that folks that are in the infrastructure layers of high tech absolutely did not see coming. It's on the radar of pretty much every one of those companies now. So think about that, because when you plot strategy, what my hope is you would do is you'd say, I'm going to work, absolutely optimize my level 1 and level 2 businesses. I'm certainly going to do that. Optimize my cost of sales, optimize my cost of service delivery, take out the wetware and put in software where I can, right? But on the other hand, you've also got to think about strategy from the right-hand side of the B for B model, which is, what would I do if I didn't have any of that legacy? What would I do if I was one of these companies coming from left field and basically saying, I get to start with a clean sheet? Yeah? Let's move to the new expectations. And I'm going to give you 4. One from a customer, one from an investor. Those are the 2 outside ones. And I'm going to give you one for your CEO and one for your CFO, because they each have slightly different perspectives. What customers, and somebody's alluded to this already, what customers are basically asking for is, look, don't shoehorn me into any one model. Give me choice, right? So there's many customers who are going to say the left side model up here, the red model, the traditional model, think level 1 and level 2, is kind of just fine. And they're saying, well, really what I want is, would you sell it to me? Would you install it for me? Would you fix it for me? And over time, would you refresh it for me? Would you come back in and refresh that technology? And there's still work to do on that side of the model. Absolutely there is. So you're going to have to keep running, you and your product peers are going to have to keep running that business model probably for as long as we're going to be in tech, because there's a lot of companies that basically say, I have CapEx to spend. In fact, it's Q4. I actually have CapEx I need to flush. It'd be great if you came in with a PO, and you're still going to take that business. Where the growth is coming, though, is in level 3 and level 4 for these different business models. And they have a different set of needs. Fundamentally, they say, don't sell it to me. They say, let me try it, which kind of gets to the land and expand selling motion, which is, don't sell me the full enchilada. Don't sell me the full bill of what I'm eventually going to need. Just get me started with it. Let me experiment with it. Let me get in a sandbox and understand what's possible. Amazon Web Services charges per minute. So you can go and experiment with 1 minute of Amazon Web Services if you want. That's the ultimate let me try it, right? Salesforce has the same thing in software. Eventually they say, well, would you just manage it for me? Because I really don't want to have the IT professionals in my organization. So once I've tried it, once I've decided I want to go this way, please manage it for me and just take the complexity off my hands. Then they say, you know what, that's not enough. What I really need you to do, Mr. Supplier or Ms. Supplier, is I'd like you to drive my full adoption. And the key word there is full. It's not did I ever turn the technology on. It's did my average user on the average day use the technology in the way that the best user on the best day of the year uses it, right? And if you think about it, we've never even really thought about that before, right? We do education, but it's what you might call just-in-case training, right? We'll pull the users into a room, we'll tell them about our new release if it's software, our amazing new CT equipment if it's a medical devices hardware business, and then we'll basically tell them all the cool things it can do, and then we'll set them loose and let them use it. And we'll never really go back and check, did the average user on the average day ever use the technology in the way that would make them most productive in their job? But customers are increasingly getting wise to that, and they're saying, you know what? I'm not buying shelfware anymore. I'm not buying all that excess stuff if we're not actually going to use it. So you, Mr. Supplier, are going to have to help me figure that out. And eventually they're saying, all right, well, eventually I want you to guarantee my business outcome. Eventually I don't want to buy WebEx for online collaboration. What I really want you to do is take down my average cost, travel cost per employee. So I'd love you to just put WebEx in for everybody, and then I'd love you to basically say, well, would you take 20% of the savings in average travel cost per employee? Because if you're on WebEx, you don't have to get on a plane as often, right? That would be an example of guaranteeing a business outcome as opposed to selling the input to a business outcome, yeah? So I just wanted to show you this because customers are getting sophisticated. This, from the work I do with CIOs and their teams, these are kind of how customers are thinking about the evolution of their requirements in both models. The investor ask. Investors are actually quite simple. For this book, we did a bunch of research with analysts on Wall Street to understand how are these companies valued, these companies that are in a B for B model or an outcome-based, consumption-oriented model. And what you see on the right-hand side of the chart is the average multiple of a set of companies that are public as-a-service companies. Those are the easiest ones to get. What's remarkable, now these are enterprise value to sales, so we've taken out the cash, but you don't really need to know that. All you need to know is for every dollar of revenue that one of these B for B companies gets, they get $7 a market cap on average. That's the basic math. And again, not to pick on any one particular company, because I could have picked, don't feel like you're immune. I could have picked anybody in this room. But these are the enterprise value to sales multiples of what we'd call traditional high-tech companies. HP at about 50 cents of market cap for every dollar of revenue. Cisco at about $1.60 of market cap for every dollar of revenue. And Microsoft and IBM at $2 and $3, right? So you say, well, why is that? Is that just a one-time thing? Is that what are investors thinking? Why are they valuing the companies on the right so much more than the companies on the left? Well, they're valuing it for two reasons: higher growth and lower risk. These companies grow faster and they're less risky because they don't have to sell their quarter every single quarter, right? The vast majority of their revenue of what they're going to book this quarter is pre-sold. So the idea that they're going to quote miss is a lot lower than the companies on the left. Everybody get that? So that's the investor ask, just give me higher growth and lower risk. So the CEO basically says, well, why not us? Seriously, why not us? These are the growth rates of the public as a service company. So we've got this 10,000 cell Excel model that basically reverse engineers the past-looking economics and the future-looking economics of every public SaaS company, infrastructure as a service, platform as a service company. And what you can see, the color coding is the type of company that they are. I know it's probably hard to read in the back. But on the left-hand side of the chart, you got Workday, which has grown at 121% year on year for 3 years compounded, right? You got Salesforce in the middle growing at 33% year on year on a $3.5 billion business, right? I mentioned Amazon Web Services growing at 100% a year on a multi-billion-dollar base. And Rackspace, who you're going to hear from Graham tomorrow, he's the chairman and founder of Rackspace, growing at 29% year on year. And your CEO is looking at you saying, well, geez, it seems like we're growing our product business at 4 or 5% a year and services growing 6 to 8 or 10% a year. What's wrong with this picture? Why can't we get that growth? We spend a lot of money on investments. Why is it not turning into a return that looks something like this, right? So there's a little growth envy going on. And the CFO, I won't spend a lot of time because JB covered this chart, but basically be a shark, not a flounder. That's really what the CFO ask is minimize the time it takes to get through this transformation between level 1 and level 2 and level 3 and level 4 so that we can get out the other side of this fish, get through the period where we're making these big investments in new capabilities and get on to the happy days, which is the end state on the right side, which is where we have incredibly fast-growing revenues like you saw in the previous chart, and eventually lower labor costs because we've invested in the software and the analytics instead of investing in putting more people on the ground. So how do we do that? I think that's the $64 million question, if you will, that's a lot of expectation. That ain't easy. So how are we going to get started? And this is where the 3 pivots come in. And there's a ton more detail. There's a chapter on each pivot in the book. So when you get a chance to read the book, there's a tremendous number of examples in there of each of these pivots. It all starts with the sales motion, though, which seems a little counterintuitive. You kind of think, well, logically, don't I need to start with what I'm going to sell and then eventually how I'm going to sell it? But what we found in the 2 years working with you and your peers on this is it's the sales motion which has got the biggest gap. Because we basically have a sales motion today in the high-tech industry which has persisted forever, which is what we call new and renew, right? Typically, product sales will go and sell a new installation of our amazing new technology, yeah? And our service sales organization will come along and renew the service contracts on the back of that product install for as long as humanly possible, because that's where all the juice in the system is. That's where all the margin comes from eventually, right? So it's a classic attach rate business, which is, I'm going to attach as much service as possible to every product install, and that's how we're all going to collectively make money, right? And I know you don't have anybody that has a sport jacket that looks quite like that, but I see enough heads nodding for you to say, yeah, new and renew. That's exactly our sales motion. That's exactly what we do today, right? And the future is not that, because in the future of a level 3 or level 4 B for B company instead of a B2B company, it's much more about land and expand. It's much more about planting a platform that enables consumption and then monetizing that consumption over time. Now, you'd say, well, maybe I just have to land. Maybe I just plant my platform in a lot of different places and kind of hope for the best, yeah? Well, if you look at the companies that are driving growth of 30% a year, 50% a year, 100% a year in these B for B models, they don't do that. They don't basically leave it up to the customer to consume at the course and speed that they might like to consume at. They basically say, no, we're going to run an expand-based sales motion, which will actively help the customer find the next leg of value in our platforms so that they can consume more and pay us more. And so I want to spend I'll speak about one slide on each of these. Landselling, you can see in both of these have a kind of what's hot and what's not feel to them. So for landselling, what's kind of not hot is selling to central IT, because a lot of these decisions, these B for B outcome-based decisions, are being made by the line of business, right? So line of business is going to be really important for your land sellers. Provocation-based selling is all about setting the buying criteria for the customer, as opposed to maybe responding to RFPs and doing solution selling where we say, yeah, we've got that too, right? Technical expertise, it's not that it's no longer important, but in an outcome-based world, a lot of that gets masked from the customer. Does anyone who uses Amazon Web Services know what brand of switch they run, or router they run, or server they run, or middleware they run, or, I don't think so, right? So technical expertise kind of is less important than potentially the business expertise. You heard from Chuck Phillips, this micro verticals, or focused on micro verticals. That's a lot of business expertise, right? All those little tiny 2,300 verticals is all about understanding the businesses that a baker runs versus the businesses that a beverage company runs, right? Social graces, look, always important. We like salespeople that chew with their mouth closed. That's obviously good. But social media is really important. So if you think of the broad range of folks that, from a sales professional standpoint, we have to touch to sell in this world, those outcomes, the range of social media is much more important. So if I was hiring a salesperson today for a land sales motion, the very first thing I'd get them to do is open up their laptop and show me their LinkedIn profile and see how many contacts they have on LinkedIn. Right? If they didn't have 500 or more, we probably wouldn't be continuing the interview. And coverage models are going to be much more about vertical coverage, exactly where Chuck Phillips and Infor are going, much less about geo coverage. But many of you still have sales organizations that are fundamentally geo. We've got Americas, we've got EMEA, we've got APAC, and kind of what's your, So that's the big difference in land selling. Expand selling is even more different, I would say. So expand selling, if you think about what we've traditionally done in the renew selling motion, it's been about renewal as the goal. And in this B for B model, renewal is not the goal. In fact, renewal is the table stakes. You're going to see evergreen contracts, and you're going to see customers that basically they want to be on contract. The maintenance for the technology is kind of embedded in the offer. So the idea that we're going to separately go and renew a maintenance contract or an optimization contract or a subscription-based services contract on the back of the overall outcome, it just really isn't important, right? Data-driven, and we talked about this, and you'll see the data handshake is the last chapter of the book, is this move from figuring out who to call and who to target, being kind of rep-based, gut-based, if you will. There's this shift to data science and data-based thinking about what's the next offer that a given customer in a given month or a given quarter needs. And the data telling the sales rep who to call, as opposed to the sales rep saying, well, I've got a certain number of customers in my patch, and I'm gonna call my buddy and hope that I get a deal, right? Inside sales, much more important than outside sales, so the cost of sales has got to come down in these models for it still to be profitable. So these idea of big enterprise sellers doing this expand selling is just not gonna work. It's gonna be much more like the compensation you might have with inside sales or virtual sales. And finally, it's much more about volume operations than complex systems. It's much less about big account plans to sell all of Citigroup, all of our stuff, and much more about the division of the retail bank in Citigroup. How are they adopting our next-gen offers, and what outcomes are they seeking, and how's that different than what the corporate bank wants, and how's that different than what the investment bank wants? So much more about volume operations, lots of smaller deals, instead of this idea of elephant hunting of we're going to go and find all the big deals.